Thank you very much. And I got to tell you, it is a thrill to be back working for you folks. I have always loved the opportunity to CPAs. I happy in Rancho Mirage, California today, and I was telling him about my devotion to helping you folks. I flew 22 out of 25 at their annual personal financial conference. I never charged them a penny. I always appreciated the chance to talk to CPAs because I always hoped they would spread the information that helped us educate people about how to be a better investor. I do have a foundation. That's who I work for. I don't get paid, but I work for them. And this mission, the mission of the foundation, is simply all about education, helping basically the do it yourself investor do it better. I believe the most important thing that people need to understand to be able to be a successful investor for the long term, is to be able to understand the math of investing. Now, I know that you are going to understand this and you already know it. This isn't going to be new to you, but I want you to see this so you'll understand why I am so picky. Why am I looking for an extra 0.1% here or there in order to help investors do better? I think you're going to understand that by the time you go through this. But quickly, I want to look at four tables. Table number one makes the assumption that one person saves over 40 years, $6,000 a year, and makes 8% during the accumulation period, and then retires at age 65. And then for the entire of their retirement, the entire period, they make 6% on their investment. So, what would that mean if you made 8 during the accumulation, then you made 6 during the distribution, and you took out 4% a year? And it turns out that if you invested $6,000 a year for 40 years, you would have invested $240,000. At age 65, the portfolio would be worth $1.7 million. You would have taken out withdrawals of $2.6 million. And at age 95, we assume that's the end of the life, there's $2.8 million for the heirs, children, and charities. Now, what does that mean? To me, it means that the return on your investment for your lifetime was how much you took out and how much you left to others. That is the total output. And if we add what you took out and what you left, you would see that 240,000 turned into $5.5 million. Now, if we made one small change, and I'll tell you why I call it small, because in my book, and there'll be a chance for you to have a free copy if you wish, but in my book, we're talking millions. I make the point that if you could just find an extra 0.5%, it could legitimately impact you to the tune of an extra $1 to $2 million in your retirement. So, what would happen if, in fact, you made 8.5% instead of 8 during the accumulation, 6.5 instead of 6 during the distribution period? And remember the 4%. Well, that extra 0.5% during the accumulation and distribution would have left you at age 65 with 1.9 million instead of 1.7, withdrawals of 3.2 million instead of 2.6, leaving 3.7 million instead of 2.8 million to your heirs. And what does that mean? It means instead of having 5.5 million, you would have about $7 million that would be in the result of all of your saving, investing, and using. In other words, an extra $1.5 million. So the bottom line is that extra 0.5% led to, over a lifetime, over $1 million. Then if we look at the next table, excuse me here, remember to use that. Whoops. Table 2, it's the same thing, except instead of an extra 0.5%, it's an extra 1%. Now, I happen to know, having been an investment advisor and charged people 1% for my services. In fact, the way I built my business is I did public workshops, 3 and 6 hours. They were all free, taught people how to do it on their own. And if they didn't want to do it, I was happy to help. But I charged 1%. So in a sense, if somebody made 9% and somebody charged them 1%, they would have been left with 8. So I can think of one real easy way that a person could have an extra 1% a year on their investment, and that is to do it yourself, other than hiring a registered investment advisor. Now, I just want to make the point here that some people would think that, oh, I get a chance to double the 1.5 million. No, you get to do better than double. And the reason you do is because you are building more money on more money. And instead of 3 million, it's a $3.5 million impact. So if I could figure out ways, or if you could figure out ways, or if you could help your clients figure out ways to make an extra 0.5% or an extra 1%, then it's really meaningful, however they do it. So,
And Paul, just a really quick question from the chat. Are these returns nominal returns, or are they adjusted for inflation?
No, they are nominal returns. Absolutely. And there are, all we're doing is we're just using the math to show this is not talking about what the market would give you. It's just assuming that you make 8%, but no taxes and no inflation.
Great, thank you.
Now let's just make another assumption, and that is, since you're building a business here, one way to build a business faster is to add money to the business and help it grow. So now I'm going to assume you added 3%. This is something you have the control of. This is not up to the market. So now let's say that with the 9 and 7, that we then make the assumption that you also add 3% a year. I particularly want young people to understand that this would be another $3.5 million from an additional approximately $212,000 additional money. An additional 200 plus thousand leads to another 3.5. So now we're up to over $12 million, part because of what you put in and part of what some market helped you build. One more, if I might, here in table 4, and that is that one person starts at age 25 while another starts at 30. Those first 5 years of your investments, and you look at the impact over the period of accumulation and over the, believe it or not, just that approximately 30 something dollars translates over a lifetime to an additional $4.66 million. Math. The adding new money or when you start, they are up to you. But the other, how much money you're going to end up making, is going to have to do with what the decisions that you make, how you invest, how you buy and hold versus market, all the things that are going to impact your long-term return. So now that we've followed a little math, let's follow some history that is important. Let's look at fixed income returns over the last 97 years, looking at short-term bonds, 1-month T-bills, intermediate 5-year bonds from the government, and 20 to 30-year maturities, again, all government paper. Going back 97 years, starting in 1928, $100 grew to about $2,300 in the short-term government bond, to about $9,700 in the intermediate term, and almost $12,000 in the long-term government bond. And what the academics would say is that the reason you made more money in the intermediates and the long-term governments is because you took more risk. So that's fine. And that's a choice we have. And a lot of people refuse to leave the safety of bonds and invest in the stock market, and are, in fact, accepting these kinds of returns for the long term. And by the way, if you looked at longer periods of time, if we looked at all of the 40-year periods since 1928, the T-bills 4.4%, intermediates 5.9%, and long-term government bonds 5.9%. Why do I recommend that if people are investing in bonds to stabilize their portfolio, that they not go long-term? Because long-term, as we learned a couple of years ago, the long-term government bond lost about 26% in 1 year. So short to intermediate, well, the short doesn't come too close to accomplishing what the intermediate does, but the intermediate historically gets about the same long-term return as the long-term bond, but at a lot less risk. But here is what I think is, when I think in terms of how could I make an extra 0.5%? Well, the easiest way I know is to put your money in stocks as a group, not one by one, but to put the money in stocks for the long term. And what we know is historically, the S&P 500 has compounded at about 10.2%, or let's just call it 10%. In essence, approximately twice that of what you got with bonds. But it is kind of amazing that while you may only double the return, that $100, instead of growing to be worth 12,000 or 2,000 or whatever that amount might have been, with the S&P 500, and this is hypothetical, this is no fees, this is no taxes, this is not adjusted for inflation, the compound rate of return would have turned that $100 to $1.2 million. And by the way, note that as you look at more risky asset classes like large cap value, would have turned into 2.6 million. Or even more risky, small cap blend would have turned into 5.4 million. Or even more risky, small cap value stocks, instead of the more conservative S&P 500, 16 million, with a compound rate of return going back for that 97 years of 13.2%. So equities, definitely for the long term. I even get upset when I see that target date funds put 10% of a 21-year-old's money into a bond. I don't want them to be in bonds when they are young. They want to have access to the risk and the long-term return. By the way, long-term return, even if you got the worst 40-year return since 1928 of 8.9% for the S&P 500, versus the very best return of 12.5%, anything in there would be a great long-term return. And it should be noted that the average compound rate of return over all 40-year periods was 11%. And of course, again, the more risk you take historically, the better return you get with these equity asset classes. 13.4% for large cap value is the average. Small cap blend 13.6%, and small cap value 16%. Now, please understand that the likelihood of getting 16% in the future is not great, because The small cap value equity asset class was really not discovered until about 30 years ago, as from at least from the academic viewpoint, maybe closer to 40 years, but it is not something that people knew about back in 1928. And by the way, they also didn't know about the S&P 500. Here's the problem. The problem is that when people see those returns, they think they're going to be comfortable taking that risk. But the fact is that living through it is a totally different experience. It's one thing for me to read a book on how to lose weight. I have found over a lifetime that the experience is way different than that book. And of course, as we know, the stock market goes up and down. But people need to know more. This is the best teaching tool that I've ever seen. I know it's very small. I'm going to show you some pieces that will be easier to read, but here's what I want you to understand this is. This is from 1928 through 2024. 1 year at a time. In fact, I'm going to go to the next slide for a second here. How did the S&P 500 do in 1928? It was up 43.6. Small cap blend 42.8. Small cap value 32%. Large cap value 24.6. And Daryl Balls, our director of research, of analytics, I should say, at our foundation, another a volunteer, he put this together in a beautiful way because, first of all, when I asked him if he could do a table that would show these returns, he didn't tell me he was going to make it a quilt chart, which makes it very easy as we look back for a second at that other larger piece. Anytime you see red, you know you got the S&P 500. You know if it's at the top, it did the best that year. If it's at the bottom, it did the worst that year. And if in between, it's where it landed each year. And what is so fascinating is that most people, particularly if they don't understand investing, are surprised how kind of volatile these different asset classes are. And the difference between the top and the bottom can really be significant. As a matter of fact, if we look just at 1928, notice between the top, the S&P 500, and large cap value at the bottom, it's about a 20% difference in the same market. And that is normal, not unusual. I mean, that's the thing that investors need to understand is the volatility of whether you're talking about the market itself or the different kinds of equity asset classes within the market. They are very different. And the better you understand that, the more likely you are to stay the course for the long term. Virtually everybody in the business, particularly John Bogle, he said the most important thing that you have to do to be a good investor is to stay the course. There are dozens, hundreds, thousands of textbooks that tell you how to put stocks together or equity asset classes together. But if you don't stay the course, if you're jumping in and out and you get scared and then you get greedy and all those things that are natural human reaction, you're not likely to stay the course. But if you understand this is the way it's going to be. And look at here. Let's look at from 2014 to 2023. A great time for the S&P 500. 2014 up at number 1. 2015. In fact, in 8 of the 10 years, the S&P 500 is king of the mountain. A couple times, 3 times, small cap value was at the top. Now, see, we expect the small cap value to be at the top a lot. We don't expect the S&P 500 to be at the top a lot because it's less risky. It's the same thing. Bonds make less than stocks because they're less risky. And by the way, bonds, if you had them on here, would be at the bottom a lot. But I want you to see something that I just think is great. I love the 4 fund strategy, 25% each of these 4 different equity asset classes. Look where it sits most of the time, right in the middle. And that to me suggests that it is more stable. And it is just another example of the power of diversification. But it's not about having 500 stocks in one fund to be diversified. It means that it is, according to the academic community, an intelligent thing to do, a smart thing to do, to put different equity asset classes together. Now, if we look at another period of time, and some of you may have been around during the period of time that the S&P 500 had a period where it was terrible. As a matter of fact, I want to tell you why it probably became terrible. It was because from 1975 to 1999, the S&P 500 compounded at over 17%. And the last 5 years before this period we're looking at right now from 2000 on, the last 5 years, it was up 28.5% over that 5-year period, compounded. So it got way ahead of itself. And as so often happens, it reverted to the mean. In fact, that's a major aspect of this whole process of putting together these portfolios, to look for good equity asset classes that do have a tendency to revert back to a mean. So look what happened. In 2000, and I had an investment, my investment advisory firm was in business in 2000. We had our clients diversified amongst not only just these, but even more. But I want you to see that in 2000, small cap value was up almost 20, the S&P 500 down 9. The next year, small cap value up 28, the S&P 500 down 12. And it goes on like that. And that is the power of diversification. But here is the easiest way to learn about all of these numbers on that page. Daryl, in giving me all those numbers, gave me this way to consider it. He looked at the top decile, quintile, the top 20%, and then the second, third, fourth, and finally the fifth. How often did small cap value end up at the top? 37% of the time. How often did it end up at the bottom? 26% of the time. How often did the S&P 500 end up at the top? Remember, it's not supposed to be up there, except the market just kind of does its things for different reasons. But whatever the reason, it was at the top 29% of the time, but it was at the bottom 40% of the time. But with the 4-fund strategy, you never were at the top and you never were at the bottom. As a matter of fact, you spent 77% of the time right in the middle. Less standard deviation, less volatility, less variability, lower risk, at least on an annual basis. But look at this. The S&P 500 compounded at 10.2. The 4-fund 11.9. In other words, a way that an investor might, I mean, we never know because we can't know the future. A way that we can not only add an extra 0.5%, but possibly even more. And then we take it in the work that we do. We have over 200 on our website, over 200 tables and graphs and charts and studies that are driven by statistics. So here is one that I started keeping track of in 1995, because it was the basis that I was teaching this to classes of people so they could learn how to do this on their own. But what I showed them was this. I assumed, and we called it, by the way, the ultimate buy and hold portfolio. It's not an ultimate portfolio because the ultimate portfolio was to put all your money in small cap value. But if you were going to diversify, what if what you did was you just built a portfolio that looks like down here at the bottom of this page, 10% each in each of these major asset classes: S&P 500, large cap value, small cap blend, small cap value, REITs, real estate investment trust, large cap blend international, international large cap value, small cap blend, international small cap value, and emerging markets. In other words, a little bit of each one of these asset classes that the academics had blessed and said these asset classes have a long history of adding value to for an investor to get a premium. So I asked this question: would it be interesting for an investor to understand how would they have done if in 1970 they had put in $100,000 and just let it go through whatever period of time? And so we're showing it through 2024. Well, here's what we know: that in the S&P 500, $100,000 would have grown to almost 30 million over that 55-year period. But if you took 10% large cap value and added it to 90% S&P 500, you would have made 0.2% more. This is why I said early on, I'm really focused on little tiny bits of different return, because if those can be translated over a lifetime, it's life-changing. So what do I know? That instead of having 29.8 million, they'd have another extra 2.2 million. And if I added 10% in small cap blend, now they'd have an extra 4 million. If I added another 10% to small cap value, you would be up now to an extra 10 million. In other words, every time I added a different asset class, and that's what this table down here at the bottom is showing you, adding each asset class, it is adding, in most cases, by the way, in the case of adding REITs, you didn't add return, but you reduced the volatility. The standard deviation went down instead of up a little bit. And finally, by the time you have completely loaded this portfolio with 10 different asset classes, including the emerging markets, your 100,000 has grown to 53.4 million instead of 29.8. No taxes, no inflation. But this one actually has expenses within the mutual fund industry. So I think that is potentially a home run. The question is, how can people actually do that? Well, one of the things we've been teaching for a long time is how to build portfolios, how to combine as a do-it-yourself investor these different asset classes. So here down at the bottom, that's what this table's all about. What if you build a portfolio that only had the S&P 500? Well, then you'd have an S&P 500 100% portfolio. Then you have the next portfolio, the ultimate buy and hold, 10% each. Then you have one where there's only 4 funds spread around the world, or another one where your 4 funds spread between large and small and value and blend only in the US. In other words, many different ways to put these together. What this shows you here in a similar kind of table is, what would the $100,000 have grown to? Well, we already know what it would have grown to with the S&P 500, and we know what it was for the ultimate buy and hold. But what if you just used 4 funds? And not only do we tell you what 4 kinds of funds, But if you're coming to our website, which is all free, by the way, everything we do is cost free. We would have had with the 4-fund strategy almost the same return as you got, in fact, a little bit better than the ultimate buy and hold. And an amazing portfolio that is so simple, just 2 funds, the S&P 500 and small cap value, that total would have been 67 million at the end of this 55 years. But then I asked Daryl if he would do something for me. I asked him if he would put together a table that would help people understand the risk and the return of these different portfolios. And again, I'm not kidding you. Every time I asked Daryl for a table, and I have to tell you the truth, I have never personally used an Excel spreadsheet. I have always had somebody who would do that for me because I was busy trying to figure out how to teach people how to do this. Well, here's what he gave me back, and I think it was absolutely brilliant. To begin with, on this page, he does have what we just looked at, the growth of, in this particular case, it's $10,000 rather than 100,000. So the numbers are a lot smaller, but they're the same relative return. Then he breaks out for me the decades. How did this particular investment do in 70 to 79, 80 to 89, 90 to 99? Why? Because people think that way. If you're coming into retirement and you're thinking about how you're going to be getting money out of retirement and the kind of return you're going to get from your investments in retirement, you kind of just your nature. Humans make stories up. If there's not an actual answer, they make up stories in their head how it's going to be. Well, here's how it was. And we should learn from it, because here is a decade that if you were taking out 4% a year, you would have ended that decade with not much more than you started with. On the other hand, the next 2 decades, 80 to 89 and 90 to 99, they were huge decades. Remember, I talked about that 25-year period between 75 and 99. But look what happened in 2000 through 2009. If this was all you had in your portfolio for the equity portion of your portfolio, you may have not made it through that decade hanging on. You might not have stayed the course. But look at this. If you looked at the ultimate buy and hold, it did better than the S&P 500. This was the reason my business took off like a rocket, because this is what we were doing for our buy and hold clients. And so they thought it was a miracle. It was not a miracle. It was nothing more than the diversification that the academics, mostly the work of Dr. Fama and Dr. French, had taught us. And then look here in 2000 through 2009, 7.3% instead of a loss of 1. But it's not all going to be easy, because over the last period of time, from 2010 to 2024, this strategy has compounded at less than 9% versus 13.9 for the S&P 500. So this is not like nirvana, where it's always going to be better than anything else you could have done. Not true. Because that's the whole idea of diversification, that you're not going to have the best. But you can look at all of these different years. Look at the 2-fund strategy, how it did. Well, it did great in that 70 to 79, 10.1% a year. On the other hand, in 2000 to 2009, it only made 4.2%. So it is a way, I think, of understanding how investing really works, how diversification really works. But Daryl took it another step, a great step in terms of education. He took all the good years, all the years the S&P 500 made money, and every one of the other strategies. How many out of the 55 did they make money? What was the average gain in those 44 years? What was the sum of all of those 44 years of profitability? And then you can compare them. For example, you might look at this as seeing, how did I do in the good times? Well, in the two fund strategy, the compound rate of return was higher. So it won't surprise you to find out that the average gain was higher than the S&P 500. But let me have you just look at the bottom line. The sum of all of the gains was 912% versus the S&P 500, 838. Okay, we would expect that because it had this higher volatility component, the small cap value. But then Daryl looked at all the down years. The S&P 500 was down 11 times. The small cap value and the S&P down 12 times. But look at this. The sum of all the losses for the S&P 500 was 159%. The sum of all of the losses for the two fund strategy was 141%. How can it be that by having half of the portfolio in something that we know is more volatile, a lot of that extra volatility, though, is on the upside, not on the downside? Because it turned out, if you look at it that way, that the small cap value S&P 500 was actually lower risk. I'm just going to shoot forward here for a second, because I want you to see this. This is 1928 to 2024. I want you to look only at those two equity asset classes, the S&P 500, the red, and the blue, small cap value. Not all the time, but most of the time, one is at the top and the other one is at the bottom, which means that if you put these two together, you are creating a portfolio that's the reason that the total losing periods were greater for the S&P 500 itself, because it didn't have this other part of the portfolio as a diversifier. And by the way, you may want to look at this in more detail. I don't want you to look at the detail here, but I want to tell you about this table. We got lots of these kind of tables where we show people what is the implication of combining, in this particular case over here, the S&P 500 with small cap value, looking from 1970 through 2024. So as you add more small cap value, what does it do to the return and what does it do to the risk? And I love this table because it makes it so easy to see. It's at the bottom of that previous table. Here's the small cap value on the right. Here's the S&P 500 on the left. And here's what happened to the return. It was 10.9% with 100% S&P 500. The worst 12 months was a loss of 43.3. If you just added 10%, so that you had 10 and 90, the risk went to 43.9. You lost 0.6% more in the worst 12 months. If you looked at the worst drawdown from a peak to a valley before going back to the peak, the worst drawdown for the S&P 500 was 51%. The worst with the small cap value as 10% was 51.6. But notice what happened to the return. Remember, I am fighting for every 0.1%. Well, the return went up 0.4%. Standard deviation went down because, remember, you're combining these two different asset classes. If we go up to 30% small cap value, 70% S&P 500, The standard deviation is about the same as the S&P 500. The worst 12 months was a loss of 45.1 instead of 43.3. The worst drawdown was 53.5 instead of 51%. I don't even think you would notice the difference. Now, what did it do to the return? You went from 10.9 to 11.9. Now, here's the problem. I cannot stamp this with the word guaranteed. If I could, I think you would buy it. If this other asset class was something other than small companies, maybe you might buy it. But this is the only asset class that we know that has this relationship of going up and down at different times. If by chance from now on they go up and down together exactly the same, so be it. On the other hand, I will tell you that the reason my wife and I gave our now 2+ year old granddaughter $10,000 to go into her 401k plan or her Roth IRA. Of course, she doesn't have earned income. She could have, but she doesn't. And so we split that money, half S&P 500, half small cap value. And when she's 18 and she gets the video from her grandmother and her grandfather and the letter from her grandmother and her grandfather and a recording and audio, I want to surround her every way that I know so that she will understand why did we do for her, because that money, whatever it's worth, is going to be used then to fund her Roth IRA. And so I really believe this has the possibilities to add value, and the extra exposure to risk is negligible. And here, by the way, the two-fund strategy that is those two, half and half, S&P 500, small cap value, 12% compound rate of return, 50-50. Versus the 10.2 for the S&P 500. Look up here, the two fund, 100% of the time in the middle. I'm not in the middle three quintiles. Now, if you compare that to small cap value, all value, which is half small and half large, it has a slightly higher return. But it also is more volatile, with part of the time out here in the top and more time at the bottom. So my point is, every one of these strategies has characteristics about them historically. In some cases, in this case, going back to 1928. When I look at those years on that quilt chart, I have, with few exceptions, no idea what was going on in 1938, 39, but I can tell, was large better than small? I don't know why. I mean, I could find out why if I wanted to study it. But what I do know is that it appears to be very random. There are times when people really like small cap, but other times they really like large, and sometimes it's value and sometimes it's growth. And the beauty is we can build a portfolio that says, I want some of all of those. $15 million decisions. In my book, we're talking millions. It's about $12 million decisions that you're going to make. I've only got a few minutes here to spend with you. I want to take the time to go through each one of these, because each one of these, I think, is huge over a lifetime. And this is something at Western Washington University where we're working with students to have them leave there and understand the right things to do, understanding that anytime they got any appreciable amount of money, there is an industry ready to find wrong things to do with your money. And you're in a business where you certainly know that because you see that. And in this list of 15, it's going to be easy to spot which is coming, what's the right fork in the road, starting with the question, save versus spend. I know what Warren Buffett says. Do not save what is left over after spending. Spend what is left over after saving. Pay yourself first. And the marvelous thing is today, in 401ks, they are now set up, not in all cases, but in most cases, where people are having to opt out in order to stop participating, as opposed to originally opting in when they were offered the choice between taking the money and living on it or putting it away for the future. Less than 30% say, I like the idea of getting a smaller paycheck. But when companies started opting people in automatically, and that money was deducted, and what they had left over was what they were expected to live on, over 80% did not opt out. I mean, only 20% opted out. That is huge for the future. I mean, we have so many unknowns about the future. We're in all of the upheaval about Social Security and Medicare, Medicaid, all of these things. Who knows what will be offered to folks? So I really want people to know that we are more and more on our own. But I will tell you, everything I know about investing, and I've been in this and around this industry since 1963, it has never been more efficient. It has never been more tax efficient. It has never been more efficient in terms of diversification. It has never been as low cost as it is today. We have never had as many index opportunities as we have today. At the same time, there has never been as much bad information as there is today, and that's because of the internet. I'm making a presentation at the Garrett Planning Network this summer about the future of investing as I see it. And they'll, I'm sure, allow me to share this presentation. Or maybe even the state will ask me to make it to you as well. But I'll tell you this. If you've gotten close to ChatGPT or other AI sources, it is such a huge step forward in information, in education, in helping people. It is amazing how much simpler they are making the process. When I go to Google and I want to search something about investing, I've got to fight my way through the advertisements. I got to take the time to read the stuff that I'm after. And sometimes it has to do with studies. I can go to ChatGPT. I tell them exactly what I want. If I want 50 studies to back up what they're telling me, they spit the 50 studies out so fast. I got to tell you, if you're not using it, I hope that you will. And by the way, it also talks to me and says, do you want to know about this other topic that has to do with that topic? Oh, yeah, that is something I should know. And then I say yes. And by the way, if I've talked about something that, like I have shared with ChatGPT, things about my portfolio, it knows that I have a major portion of my portfolio in small cap blend and small cap value, about half of my equity. And I had asked a question, and in the answer, they brought up the fact that I had mentioned that information about the small cap value weeks ago. It is pretty amazing. All right, back to basics. Save earlier over saving later. Well, I already went through that with that extra 5 years. Huge. As a parent, as a grandparent, boy, if you can help kids and grandkids, help get them through that time, that first 5 years, it is gigantic. And my God, if there's a match to go with it, I mean, what a bonanza if you make it possible. That's better than leaving money to them later. yes, they're going to have the ability to cash it out. What I told my kids, because I did their IRAs for them, if they made the money, I would match it. What I told kids was, this is the deal. I match this money until we get a certain age. And if I ever find out that you have spent any of that money, I will tell you it is the last money you'll ever get from me. My son he has turned 59 and a half. And he proudly wanted to tell me that he had not touched a penny. And I asked him, did you think that I meant it? And he said, yes, I thought you meant it. Stocks over bonds, I've already talked about that. Many stocks over fewer. It is a myth that fewer stocks are likely to make more money than more stocks. The academic community has made that point clear. If you want to get the winners, you buy the entire market, because when you buy, even if it's the S&P 500, because if you get the S&P 500, you're going to get the winners, the big winners. And it is those big winners, 1 out of 25 stocks, 1 out of 25, 4% of the companies are responsible for most of that 10% that we know the market has given over the last 90 some years. But if you look at the other 96%, the average return is 3%. Lower expenses over higher. Looking for a 0.5%, put your money into a zero expense index fund at Fidelity versus an active manager that's charging you 80 basis points, 0.8%. Lower taxes over higher. Well, you know something? You get into an ETF, you get into an index, you're going to have lower taxes. Believe it or not, if you invested in the God, I can't remember. It's an index fund that equally weighted the S&P 500 as a fund. It has a cost, an annual tax cost of about 1.8% a year. If you buy the same fund as an ETF, the tax cost is about 60 basis points. It is 1/3 the tax cost to an investor if they're in a taxable account. Index over active management. That's a home run. 1 out of 10 to 1 out of 20 actively managed funds are able to do as well as an index. I want you to add value. I want you to add small to your portfolio. Doesn't have to be a lot. Maybe it's only 10% small value, 10% large value, 10% small cap blend. I'd rather have the value than the blend, but I want to encourage you to have more equity asset classes. I want to encourage you to buy and hold every study. And I understand market timing as well as I understand buy and hold. I could talk for 2 hours about market timing, but I will tell you what I know. If I told 100 people 50 years ago how to buy and hold the S&P 500, and they stayed the course, did exactly what I said, then all 100 people, theoretically, if they didn't spend any of that money, they all put it in the Vanguard S&P 500 machine, they would have had the same return, an amazing return. On the other hand, if I told them they should be dashing in and out of the market, and I told them about a number of different market timing systems, I guarantee you that no more than 5% of the people that use market timing would have outperformed the S&P 500. By the way, most of them would have given up because market timing causes people to sell out. I don't care whether it's for political reasons, economic reasons. By the way, to go from 100% equity to 90% because you're older, or because you're just find out you're going to die. One of our favorite writers, one of our truth tellers, Jonathan Clements, he doesn't have long to live in his articles about his living, knowing he's about to die and investing. Really great stuff. I know I've got just a minute here. Dollar cost averaging over waiting for a better time. Always, if you're thinking about, that's again market timing. If you're waiting, target date funds, great. Study shows target date funds in 401ks are built to make about 2.3% more a year than the investors in 401k plans that are not using target date funds. I would hope that if you are doing a target date fund, and we have a free book about this, that you add a little small cap value. Do it yourself versus hiring an advisor. Boy, if you can figure it out, and that's what we're here to do, then I hope you'll try to learn how to be a do-it-yourself investor. The payoff is as big as going to college. If you're going to hire an advisor, hire an hourly advisor. There are some amazing hourly advisors. And if you have to hire an assets under management advisor, of course, make sure they're a fiduciary and make sure you don't overpay. Free books, all PDFs available on our website. Or by the way, if you have the PDF, which I think you have access to there, then you can just go right to this link and get a free book. We're talking millions. I wrote that one. This one was written by our director of research, Two Funds for Life, how to combine target date funds and small cap value in some very clever ways. And this is a wonderful book. He is also a director. We have 3 directors. They all wrote a free book. God bless them. Spending Your Way to Wealth. There are 48 biases we come with. Most of those biases get in our way of staying the course. There is a book written by Daniel Kahneman entitled Thinking Fast and Slow. It's a great book. It talks about those 48 biases. It's 500 pages long, and I've never met anybody who finished the book. Now, the first half is easy reading, and I recommend it highly. But I will tell you that in the back of this book, those 48 are covered in 16 pages. So if you got it for no other reason than to read the appendix, it is worth the time to understand the challenges that we have. Everything I've said today is meant to be taken as entertainment. I would like to think it's more than just entertainment, but I cannot be an advisor. I was at one time. Now I am a hardworking, underpaid teacher. Will I answer emails? Yes. As a matter of fact, if something I said today offended you or didn't make sense, paul@paulmerriman.com. I hope you will become a free subscriber at our website. We have over 800 articles, podcasts, and as well as videos. And if you go through our boot camp, it takes about maybe 20 hours, I promise you will know a lot about investing, and you'll be introduced to most of those 200 tables. So thank you. And thank you, Nick, for inviting me to do this. I'm always to come help. And what I will do is, if you will supply me the chat.
Yeah, absolutely.
If people have included their phone number, I'm not their phone number, but their email address, if there's a question there. And by the way, I see the thank yous. Thank you very much. That is really nice to hear. That is my pay. And by the way, I absolutely love it. And I think I saw in that list of thank yous one of the finest hourly advisors that I know of. And if anybody wants to know who she is, they can email and I'll tell you. Okay.